Do you feel like investing is only for the wealthy or financial experts? You're not alone. Many beginners hold back out of fear of losing money or making the wrong move. But what if I told you that not investing could be the biggest financial mistake of all? If you've ever wondered where to start, or if investing is even right for you, this video is exactly what you need. I'm going to break down the 10 things you must know before you invest a single dollar, including why investing matters, how your money grows, which mistakes to avoid, and the mindset that separates smart investors from broke ones. It's practical, beginner-friendly, and packed with real value. No hype, just clarity. Every day you delay investing, you're losing time, and time is your most powerful asset. Do you really understand how compounding works? Are you falling into traps that most new investors don't even see coming? If you're serious about building wealth, don't skip this. These 10 lessons could save you years and thousands of dollars. You're watching Wealth Circuit IQ, your go-to guide for smart, beginner-friendly investing. If you find value in content that makes money simple and actionable, make sure to like this video and subscribe for more insights that can transform your financial future.
What is investing? All right, let's start from the very beginning. What is investing? At first glance, investing might seem complicated or like something only wealthy people do. But at its core, it's actually simple. Investing is just a way to make your money grow over time by putting it to work instead of letting it sit idle. Imagine this. You have a small garden plot. Right now, it's just a patch of dirt. You could ignore it, or you could plant a seed. Not just any seed, a tree seed. You plant it, water it, take care of it, protect it from pests, and give it time. Eventually, that tiny seed becomes a tree that produces fruit year after year. That tree, that's your investment. But here's the twist. Imagine that tree has a magical property. Every year, it not only gives you fruit, but also drops seeds. Seeds that grow into more trees, which also produce fruit and even more seeds. Over time, you're not just harvesting from one tree. You've grown a forest. That's what smart investing can do. It multiplies over time. So let's break this down in real terms. Investing means using your money to buy something that has the potential to grow in value or generate income. This could be stocks, bonds, real estate, mutual funds, or even a business. Unlike saving, which simply protects your money, investing aims to grow it. The key ingredient? Time. Investments don't grow overnight. They need years, even decades, to reach their full potential. That's why patience is one of the most powerful tools any investor can have. And yet that's also where most beginners get frustrated. They want fast results. But investing is not about instant gratification. It's about long-term growth. Real-life investing example. Let me tell you about Lisa. Lisa was nervous about investing. She thought it was complicated or risky. But she started small, just $50 a month into an investment account. She didn't check her investments daily or panic when the market dropped. Instead, she kept watering her money seed every month, letting it grow quietly. 10 years later, Lisa's $50 monthly habit turned into over $10,000, all without any magic, just the power of investing in time. Important note, investing is not a get-rich-quick scheme. It's a long-term journey, like planting and tending a forest, not instant fireworks. But it's the best way to build real, lasting wealth. Why should you invest? Now that we know what investing is, why should you actually do it? Can't you just save money like your parents or grandparents did? Great question. Let's explore the real reasons investing is crucial in today's world. The inflation trap. Here's a story to illustrate inflation. Meet John. John saved $1,000 under his mattress for 20 years. He thought he was doing a great job. But when he finally pulled out the cash, he realized that $1,000 back then only buys about $600 worth of things today. Why? Because prices go up every year. The cost of food, rent, clothes, everything. This is called inflation. If your money just sits there doing nothing, inflation quietly eats away its value. How investing fights inflation. Investing gives your money a chance to grow faster than inflation. For example, historically, the stock market returns around 7% per year after inflation. If your money grows 7% but inflation is 3%, you're still gaining about 4% in real purchasing power. Story. Meet Maria, a saver versus investor. Maria kept $5,000 in a bank savings account, earning 0.5% interest. After 10 years, she had about $5,250, barely more than she started with. Her friend Raj invested the same $5,000 in a diversified stock portfolio, averaging 7% annually. After 10 years, Raj's investment grew to over $9,800. The difference? Investing made Raj nearly double his money, while Maria's savings barely kept up with inflation. What if you don't invest? Your money loses value in purchasing power. You miss out on opportunities to grow wealth and achieve your goals faster. Investing for your goals. Think about your dreams: buying a house, traveling, retirement, or starting a business. Investing gives your money the power to help you reach these dreams much faster than saving alone. Why starting early matters. Let me share a little secret. Time is your most powerful tool in investing. If you start investing at 25, you have decades for your money to grow through compounding. If you wait until 45, you lose valuable growth years. Example: starting with $1,000 at age 25 and adding $200 monthly at 7% returns can grow to over $500,000 by age 65. Starting the same at 45 might only reach around $100,000. Time literally turns small seeds into a forest. The purpose of investing. Have you ever stopped to ask yourself, why am I investing? Not just how or where, but why? The truth is, investing isn't just about making money. It's about using money as a tool to create freedom, stability, and opportunities. In this video, we're going to explore the true purpose of investing by breaking down 4 core goals: capital appreciation, income, diversification, and passive income. Then we'll connect all of it to something even more important: your life goals. Let's begin with the most common reason people invest: capital appreciation. This simply means growing the value of your money over time. You buy an asset, like a stock, a mutual fund, or a piece of real estate, and hope it increases in value. When it does, your wealth grows. Capital appreciation is especially important for long-term goals: retirement, buying a home, starting a business, or creating generational wealth. If you're in your 20s or 30s, your biggest advantage is time. Thanks to compound interest, small, consistent investments made early can grow into something massive later on. Capital appreciation is the engine behind that growth. But not everyone wants to wait 20 or 30 years to see a return. That's where income investing comes in. This strategy focuses on generating consistent cash flow right now. Maybe it's dividends from stocks, interest from bonds, or rental payments from real estate. These sources of income can help cover living expenses, supplement a salary, or provide financial security during retirement. For someone who wants stability over high growth, income investing offers a steady hand. It's not just about how much money you have, but how easily that money can support your lifestyle. Then there's diversification, a goal that's more about safety and resilience than profit. Diversification means spreading your money across different asset classes, stocks, bonds, real estate, international markets, so that no single failure can take everything down. Imagine putting all your money into one stock, and then the company crashes. That's the risk diversification helps prevent. A well-diversified portfolio can smooth out the bumps and reduce the emotional stress of investing. It protects you when the unexpected happens, which in life and investing is inevitable. Next is a goal many people dream of: passive income. This is the idea of money flowing in regularly with little to no ongoing effort. Think of dividend-paying stocks, real estate that generates rental income, or automated online businesses. The beauty of passive income is that it frees up your time. You're not trading hours for dollars. You've created a system where your money works for you. For some, passive income is the path to early retirement. For others, it's a way to fund creative projects, travel the world, or simply reduce financial stress. So how do all these goals, capital appreciation, income, diversification, and passive income, actually connect to your life goals? Simple. Investing is not just a financial plan, it's a life plan. Whether your goal is to buy your first home, put your kids through college, travel full-time, retire early, or just have peace of mind, investing is the bridge between your current income and your future vision. It gives you options. It builds freedom. It replaces worry with confidence. Every dollar you invest is a step toward a future you've chosen, not one you've settled for. Before you make your next investment decision, ask yourself, what is this investment doing for my life? Is it helping me grow? Giving me income? Reducing my risk? Creating freedom? When you invest with purpose, you stop chasing numbers and start building a future that truly matters. Types of investments deep dive. Now, let's get to the exciting part: what you can actually invest in. There are lots of choices, but I'll break down the main ones so you can understand and feel confident. 1. Stocks. Owning a piece of the future. When you buy a stock, you own a tiny piece of a company. Imagine buying a ticket to a concert. If the concert becomes a huge hit and sells out every night, your ticket's value goes up because everyone wants it. Stocks work the same way. If the company does well, your piece becomes more valuable. Real example: if you bought Amazon stock 20 years ago, your investment would be worth hundreds of times what you paid. But beware, stocks can be volatile. Prices go up and down daily based on company performance, news, and the economy. 2. Bonds. Lending money and getting paid back. Bonds are like loans you give to companies or governments. Imagine you lend $100 to a friend, and they agree to pay you $5 every year and give you back your $100 after 10 years. That's what bonds do. They're safer than stocks, but usually have lower returns. 3. Mutual funds and ETFs. Instant diversification. If picking individual stocks feels overwhelming, mutual funds and ETFs are for you. They pool money from many investors and invest in a mix of stocks and bonds, giving you broad exposure and lowering risk. 4. Real estate. Owning property. Buying property lets you earn rental income and benefit from value increases over time. It's a great way to diversify, but often requires more money and management. 5. Alternative investments. Brief mention. There's also investing in gold, cryptocurrencies, collectibles, and more, but those can be riskier or complex for beginners. So, what kind of investment sounds interesting to you? Stocks, bonds, or something else? Comment below. Risk versus reward. How to think like a smart investor. Have you ever wondered why some people invest in cryptocurrency while others stick to government bonds? Or why some chase the next tech startup while others are happy with a simple savings account? The answer lies in one of the most important principles in investing: risk versus reward. Understanding this balance is the foundation of every smart investment decision. It's not just financial jargon. It's how investors manage fear, opportunity, and growth. Let's break it down. The basic principle is this: the higher the potential reward, the higher the risk you're likely taking. That's it. It's a simple concept, but one that drives nearly every decision in the investing world. Want to potentially double your money in a few months? You'll likely be taking on a high risk of losing that money too. On the other hand, want to keep your money safe with a guaranteed return? You'll probably earn very little in interest, but you'll sleep peacefully at night. Imagine this with a ladder. At the bottom, you have low-risk, low-reward options, like savings accounts, treasury bonds, or certificates of deposit. These won't make you rich, but your money is safe and predictable. As you climb higher, you'll find things like blue-chip stocks, index funds, and real estate. Moderate risk, with historically solid returns over time. At the very top, high-risk, high-reward assets like cryptocurrencies, speculative stocks, startups, or options trading. These might offer big returns, but they also come with the chance of losing a lot, fast. Now, let's introduce a term you'll hear a lot: volatility. Volatility refers to how much an investment's price moves up or down in a short period of time. A highly volatile investment might double in value one month and drop by 50% the next. A low volatility asset, on the other hand, tends to have slow, steady changes. Volatility doesn't automatically mean bad, but it does mean unpredictable. If you can't handle the roller coaster, you might prefer something with less dramatic swings. That brings us to another critical concept: risk tolerance. This is your personal comfort level with uncertainty. Some people are natural risk takers. They're okay seeing their investments go up and down, knowing the long-term potential is high. Others are more cautious. They prefer slow and steady growth, even if it means lower returns. Your risk tolerance depends on a few factors: your age, your income, your financial goals, and even your personality. Someone in their 20s saving for retirement might be fine taking on more risk because they have time to recover from losses. But someone just 5 years away from retiring might not want to gamble with their nest egg. There's no one-size-fits-all answer. What matters is aligning your investments with your goals, timeline, and emotions. If you panic every time the market dips, you might end up selling at the worst possible time. That's why understanding your own risk tolerance is key. The best investment strategy isn't necessarily the one with the highest return, it's the one you can actually stick with. Let's put this into perspective. Say you invest $10,000 in a low-risk bond with a 3% return. After 1 year, you make $300. Safe and steady. But what if you put that same $10,000 into a high-risk stock that could either go up 50% or down 30%? You could make $5,000 or lose $3,000. There's no right or wrong choice. It all comes down to what you're trying to achieve and how much risk you're willing and able to take. At the end of the day, risk and reward are two sides of the same coin. You can't chase big gains without being prepared for big drops. And you can't expect complete safety and also expect huge returns. The trick is finding the balance that works for you. So before you invest in anything, whether it's stocks, crypto, real estate, or even a business, ask yourself, what's the potential reward? What's the risk? And am I comfortable with both? Time horizon and power of compounding. Have you ever heard the phrase, time is money? Well, when it comes to investing, time isn't just money. It's a money-making machine. Let's talk about the single most powerful concept in personal finance: compounding. Compounding in investment refers to the process where the returns earned on an investment are reinvested to generate additional earnings over time. This cycle of earning returns on both the original capital and the accumulated gains leads to exponential growth, making time a critical factor in long-term wealth building. Here's how it works in plain numbers. Let's say you invest $1,000 in a fund that grows 10% per year. After 1 year, you have $1,100. In year 2, you earn 10% on $1,100. Not just the original $1,000. That's $1,210. In year 3, $1,331. By year 10, that same $1,000 becomes nearly $2,600. And by year 30, over $17,000. Let that sink in. $1,000 turns into $17,000 just by sitting there and growing. That's the power of compounding. But here's the kicker. Compounding only works if you give it time. And the earlier you start, the harder your money works for you. Let's look at another examples. Alex starts investing $200 a month at age 20. They invest for just 10 years, then stop contributing at age 30, but never touch the money. By retirement at 65, Alex has around $314,000. Now meet Jamie. Jamie waits until age 35 to start. They invest the same $200 a month, but for 30 straight years until age 65. Guess what? Jamie ends up with about $283,000. Jamie invested 3 times more, but ended up with less. Why? Because Alex gave compounding a 15-year head start. Time did the heavy lifting. This is why your time horizon, how long you stay invested, is everything. The earlier you start, the more time your money has to grow. And the more patient you are, the more powerful the compounding effect becomes. It's not about how much you invest. It's about when you start and how long you let your money grow. So here's the bottom line. Start early. Stay consistent. Be patient. Let compound interest work for you, not against you. Because the most valuable investment tool isn't money. It's time. How investing grows your money. Now, the heart of investing. How your money actually grows. Compound interest. The snowball effect. Imagine rolling a tiny snowball down a hill. At first, it's small, but as it rolls, it picks up more snow, getting bigger and bigger until it's a giant snowball. Compound interest works the same way. Your earnings generate earnings, which generate even more earnings, and so on. Math example. If you invest $1,000 at 7% annual return, year 1, $1,070. Year 2, $1,145, 7% on $1,070. Year 10, over $1,967, your money nearly doubles in 10 years without adding a penny. Capital gains versus income. Capital gains, selling an investment for more than you paid. Income, dividends or interest paid to you regularly, both can be reinvested to turbocharge your growth. Real-world story. Warren Buffett. Warren Buffett started investing as a teenager. By reinvesting his earnings over decades, he built a fortune worth over $100 billion. Patience is key. Investing isn't about instant wins. It's about steady, long-term growth. Markets go up and down, but historically they trend upwards over years and decades. If you found value in today's guide, don't forget to like, subscribe, and turn on the bell icon so you never miss a financial insight from Wealth Circuit IQ. And let us know in the comments, what's your biggest investing question or goal? We're here to help you grow every step of the way. How to start investing, step by step. All right, ready to get started? Let's walk through a clear, beginner-friendly roadmap to help you take action and begin investing with confidence. Step 1. Define your financial goals. Before you invest a single dollar, take a moment to understand why you're investing. Your why is your anchor. Are you aiming to retire comfortably at 60, save up for your dream home, build wealth for your children's education, or simply gain financial freedom and flexibility? Write these goals down. Be specific. Include timelines and amounts if possible. Clear, personal goals help you stay focused, make better decisions, and avoid emotional mistakes when the market gets bumpy. Step 2. Understand your risk tolerance. Investing always involves some level of risk, and it's important to know how much uncertainty you can handle. Ask yourself, how would I feel if my portfolio dropped 20% in value? Would I panic and sell or stay calm and trust the process? This helps determine whether you should invest more conservatively, like with bonds and stable funds, or more aggressively, like with stocks or growth funds. Use online risk tolerance quizzes, or consult a financial advisor to understand where you fall on the risk spectrum. Step 3. Open an investment account. You can't invest without a proper account. Here are your options. Brokerage accounts. Platforms like Robinhood, Fidelity, Charles Schwab, or Vanguard let you buy stocks, ETFs, and more. Retirement accounts. If you're focused on long-term savings, consider a Roth IRA, traditional IRA, or a 401k through your employer. Most modern apps have zero or low minimums and offer intuitive interfaces. Just follow the on-screen steps. It usually takes less than 10 minutes. Step 4. Start small and be consistent. Don't wait to have enough money. Start with whatever you can, even $25 a week. The key is consistency. This method is called dollar cost averaging, where you invest a fixed amount at regular intervals regardless of market conditions. It smooths out the risk of buying at a high price and builds discipline. Remember, investing is a habit, not a one-time event. Step 5. Diversify your portfolio. Diversification simply means not putting all your eggs in one basket. A diversified portfolio includes a mix of stocks, companies of different sizes and sectors, bonds, corporate or government, mutual funds or ETFs for broader exposure, and possibly real estate or alternative assets later on. Diversification protects you if one part of the market underperforms. Your other investments can help balance things out. Step 6. Keep learning and stay patient. Finally, understand that investing is a lifelong journey. The market will rise and fall, sometimes sharply. The worst mistake beginners make is panic selling during downturns. Stick to your plan, revisit your goals regularly, rebalance your portfolio if needed, and stay the course. And never stop learning. Read books, follow reputable finance channels, and talk to a financial planner as your wealth grows. You're not just investing money, you're building the life you want. Investing versus trading. Before you put a single dollar into the market, there's one concept every beginner must understand: the difference between investing and trading. Why is this so important? Because choosing the wrong path for your goals and personality can cost you more than just money. It can cost you confidence, consistency, and peace of mind. It's one of the most common traps new investors fall into, thinking they're investing when they're actually trading, or vice versa. And that confusion, it leads to panic, poor decisions, and disappointment. Understanding this difference is like learning the rules before playing a game. Without it, you're reacting emotionally, chasing trends and hoping for luck. But with clarity, you make intentional moves, stay focused, and build a real strategy. So, let's break it down. Investing is a long-term journey. It's about planting seeds today that grow slowly, steadily, and predictably over time. Investors think in years, not days. They look for assets that will appreciate in value and deliver returns through growth or income. The goal is wealth creation, not quick wins. This approach is built on patience, research, and trust in long-term trends. Trading, on the other hand, is more like a fast-paced chess match. Traders aim to profit from short-term price movements. The focus is on timing the market, reading patterns, and making quick decisions. It requires more attention, more risk management, and a completely different mindset. Traders aren't necessarily looking to own an asset. They're looking to profit from its volatility. So, how do you choose? That depends on your goals, your tolerance for risk, and how much time you're willing to dedicate. Neither is better or worse, but confusing the two can lead to frustration and failure. This is one of the 10 most important things you need to know before you start your investing journey. Because when you know whether you're building wealth over time or chasing opportunities in the moment, your decisions become clearer, and your chances of success skyrocket. The psychology of investing. Let's talk about something most beginner investors overlook, but it's arguably the most powerful factor in your success: the psychology of investing. Because investing isn't just about numbers, charts, or strategies. It's a test of your mindset, discipline, and emotional resilience. The markets will challenge you. Prices will go up and down. News will cause panic. Social media will tempt you with hype and fear. In those moments, it's not logic that drives decisions. It's emotion. Greed, fear, impatience, and overconfidence are the biggest threats to your investment journey, not the market itself. Understanding your emotional patterns, how you react to gains, losses, and uncertainty, is critical if you want to grow your wealth consistently. Successful investing requires mental strength and long-term thinking. That means resisting the urge to chase every hot trend, staying calm during downturns, and trusting your strategy even when others are panicking. The truth is, your ability to manage your behavior is more important than your ability to pick the perfect stock or time the market. Emotional discipline is your edge. It's what separates real investors from gamblers. So before you dive into charts and portfolios, take time to build your mental framework. Because the right mindset doesn't just protect your money, it compounds your growth. Mastering the psychology of investing isn't optional. It's the foundation of every smart, sustainable financial decision you'll ever make. Busting myths and final tips. Before we wrap up, let's bust some common investing myths. Myth number 1. Investing is only for the wealthy. Not true. You don't need thousands of dollars to start. In fact, Many people begin with as little as $5 or $25 a month. Thanks to low-cost apps and fractional shares, investing has never been more accessible to everyday people. Myth number 2. You need a finance degree. Nope. While financial education helps, you absolutely don't need to be a Wall Street analyst. Basic knowledge, consistent learning, and using tools like index funds or robo-advisors can get you started and keep you on track. Myth number 3. Investing is gambling. That's a common misunderstanding. Gambling is based on chance. Investing is based on strategy. When you invest, you're buying real assets that have the potential to grow over time. With research, planning, and long-term thinking, investing is far more predictable than luck-based games. Myth number 4. You have to pick winners to succeed. Many beginners think they need to find the next Tesla or Bitcoin to win, but in reality, slow and steady wins the race. Diversified portfolios, index funds, and consistent investing often outperform risky individual stock picking in the long run. Final advice: start now, even with little money. Invest for the long term. Keep emotions out of investing. Use low-cost index funds if unsure. Final conclusion. This concludes your comprehensive beginner's guide to the fundamentals of investing, meticulously curated to empower your confident entry into the financial landscape here at Wealth Circuit IQ. Should this guidance have proven beneficial, your engagement through a like, subscription, and activation of notifications will ensure you remain informed of future insights designed to foster your financial growth. We also encourage you to share this resource with peers embarking on their wealth-building journey. Quick disclaimer. Please be aware that neither I nor the entity Wealth Circuit IQ are credentialed financial advisors. The perspectives shared herein reflect personal opinions and should not be interpreted as formal financial counsel. Have questions? Drop them below. We are dedicated to supporting you throughout your investment endeavors. Thank you for joining us here at Wealth Circuit IQ today. We wish you success on your investing journey. Until our next discussion.